I keep getting questions about how low-cost brokers in Europe for buying stocks and ETFs actually make money. After all, some of them, like Trade Republic, offer commission-free recurring investments, and direct orders only cost a flat €1 fee no matter the amount. Not only that, they pass on the entire 4% interest rate the ECB is currently paying on cash. How can that be sustainable compared to other brokers with higher fees? And now that the EU decided to ban payment for order flow from 2026 onwards, is their business model in trouble? Since PFOF is such a heated topic, we'll also try to find out if investors are generally better or worse off when it is being used by a broker. For example, does it result in any hidden fees or other downsides to be aware of? Today we'll discuss all of that and take a closer look at 6 ways well-known European brokers like Trade Republic and Interactive Brokers make money. I'm willing to bet you're going to be surprised by some of their revenue sources. Alright, let's not waste any more time and jump right into it, starting with interest on uninvested cash. For many banks and brokers that either pay zero or very little in interest to their customers, this has become a very profitable revenue source. Since they're able to earn 4% per year on customer deposits risk-free ever since the ECB raised its short-term deposit rate to 4%. Trade Republic is the only broker that has been passing on that exact interest rate one-to-one to its customers, while still securing deposits via €100,000 bank deposit guarantee. Which is why my wife and I have been using the broker not only for investments, but also as a high-yield savings account for our cash reserves ever since they started paying interest. Meanwhile, Interactive Brokers also pays very competitive interest rates on cash in many different currencies, but they sadly don't pay interest on the first €10,000 worth of cash, only on the amount above, and you get a blended rate based on the size of your Interactive Brokers account. What this means is that Interactive Brokers is likely able to generate quite a bit of income from the cash sitting on customers' accounts, due to there being a difference between what customers are paid and the risk-free rate they're able to generate on this money. At the same time, since Trade Republic is directly passing on the 4% that banks are earning via short-term deposits at the ECB, they're probably not making anything extra on uninvested funds as it stands right now. That being said, they were the first broker to pay the full 2% rate back in January 2023, and they only raised that rate once on October 1st directly to the 4% interest rate the ECB introduced 10 days earlier. As a result, they were able to generate millions of euros in profit from the difference in rates from February to September 2023. As you can see, depending on where rates stand and what your broker pays out at the time, uninvested cash can be a significant revenue source, which makes it even more sad that most banks and brokers are still paying zero in interest to their customers while pocketing the entire difference themselves. Before we move on to the next income source, you can find my links to the best low-cost brokers in Europe down below in the description, which is a great way to support me if you'd like to. And don't forget to subscribe while you're there. The second way brokers make money is via the order fees its users pay whenever they invest their money. On Interactive Brokers, this fee starts at 0.05% with a minimum of €1.25 when buying ETFs like the Vanguard FTSE All-World, for example, using the tiered pricing model. Recurring investments on IB come with the exact same fee. Meanwhile, on Trade Republic, you only pay a flat €1 fee for direct orders, no matter the amount, and recurring investments, aka saving plans, are commission-free, which is especially useful if you're going to invest smaller amounts on a regular basis. Okay, but how is that actually possible? Well, this is where income source number 3 comes in: commissions paid by financial institutions. When an order is executed via Trade Republic, either directly or via a saving plan, the broker receives additional commissions from external financial institutions called third-party grants. Let's take a look at the cost information document on Trade Republic to show you what I mean. For example, let's say we want to buy €1,000 of the Vanguard FTSE All-World ETF right now. Before placing the order, we can see the cost information document, which confuses a lot of investors and leads many to believe there are hidden costs that are not being disclosed, which is not true, as you'll see in a second. At the top, we can see the cost of our purchase, in this case the flat €1 fee. Then the cost during the holding period per year. This is simply showing you the ETF internal fees based on its total expense ratio, in this case 0.22%, and then we see the €1 fee you would need to pay for selling your shares again. We then have the same thing again, just summarized into one amount at the year of purchase or sale, and lastly, the part that likely confuses most investors, the split of total costs and impact on the return. This assumes a holding period of 5 years and the purchase as well as sale of these shares at the start and end of it, resulting in €2 of trading fees paid by you to Trade Republic, shows the total expense ratio multiplied by 5, so the fees you pay within the ETF over 5 years, and lastly, third-party grants. These third-party grants are not paid by you, they're paid by external financial institutions to Trade Republic. Basically, these are the payments Trade Republic receives for sending your ETF or stock order to the Lang & Schwarz exchange for execution, also known as PFOF, which is short for Payment for Order Flow. But prices are still linked to the largest public exchange in Germany, etc. So if you place your orders during its opening hours from 9 to 17:30 Central European Time, you benefit from the same tight spreads while paying a lower flat €1 fee. For example, right now on Friday at 12:22, you can see that the spread, so the difference between the buying and selling price for the FTSE All-World, is very close on Trade Republic. Meanwhile, if you're dealing with US stocks, it might make sense to trade them between 15:30 to 17:30, since US exchanges will already be open during that time. The commission-free saving plans are also always executed at a time with tight spreads in the market. Either way, you always have the option to place a limit order instead of a market order, where you set the maximum price you're willing to pay per share. This may make sense, especially if you're placing your order before 9 in the morning or after 17:30, for example, when spreads widen due to the public exchange, etc., being closed at that time. The German regulator BaFin also found payment for order flow to generally be beneficial for investors in a study. Especially for smaller orders, PFOF was better most of the time, while the benefit was lost with larger orders or orders containing shares that are traded less frequently. But this study was looking at German stocks specifically, so what about ETFs, which is how most of us are investing our money? Well, in the German subreddit Finanzen, there's a useful post looking at spreads across different PFOF exchanges compared to etc. at the same time in July 2023. In this analysis, in July 2023, the Lang & Schwarz exchange used by Trade Republic actually had a better average spread compared to etc. during its opening hours from 9 to 17:30 for each of these ETFs. This list includes our favorite, the accumulating Vanguard FTSE All-World, where LNS used by Trade Republic had a significantly lower spread of 0.037% compared to 0.046% on etc. Another thing this analysis shows us is that spreads widen significantly when we trade outside of regular market hours. So as long as you keep that in mind and place your orders between 9 to 17:30 Central European Time, or simply place a limit order if you're outside of that time frame, in my opinion, there's no reason to complain about payment for order flow as a buy and hold investor, since you're getting a great deal, at least the way it is implemented here, as in lower trading fees or non-existing fees via saving plans, and surprisingly even tighter spreads compared to the reference market. And based on my own experience when placing a market order at the exact same time, both on interactive brokers without payment for order flow and Trade Republic a few times now, I've been getting the same price per share. My friend Giorgio, aka Mr. Rip, reported the same in his own testing, which he shared live in a video 3 months ago. Now, as it turns out, there's an additional way Trade Republic earns money from our investments in ETFs. Payments by fund providers like BlackRock, aka iShares, and others. Based on what I was able to find out from my contacts at the broker, it looks like Trade Republic also earns small commissions from fund providers like iShares, Vanguard, Spider, Amundi, etc. when its users invest into their ETFs. Since the broker is acting a bit like a supermarket for financial instruments to its now significant user base of over 4 million, fund providers are willing to pay Trade Republic a small percentage of what they're making themselves on an ongoing basis from investors in their ETFs via each fund's TER, aka total expense ratio. And just to clarify, fund providers are paying this commission out of pocket from what they already make from each ETF internally, which is the same no matter which broker we use. So this is not an additional fee we pay as investors. I haven't been able to find out yet if this external commission is already included in the cost information document, but I did find it interesting that the third-party grants, which we talked about a few minutes ago, seem to be 3 times higher when buying 1,000 euros worth of an ETF from iShares compared to Vanguard, for example. So don't be surprised if you see iShares ETFs pop up right away when you explore which ETFs are available on Trade Republic. This is most likely the reason why, which does make sense from a business perspective, and I have no problems with it as long as all the other ETFs by other fund providers like Vanguard are available as well, which they are. Still, I found it quite interesting to find out that this was another income source for Trade Republic, as I wasn't aware of it beforehand. Now, there are 2 areas where Trade Republic generates significantly higher commissions on trades compared to stocks and ETFs. First, directly from derivative issuers like UBS, HSBC, etc., when a derivative like an option on a stock is purchased. I would strongly advise against using these vehicles though, unless you're a professional in the field, which I'm certainly not. And second, when people invest into Bitcoin or other crypto via its partner Bankhaus Scheich, where the spread between the buying and selling price is significantly larger at around 0.8%. Moving on, Currency exchange fees are another income source for brokers. This part is irrelevant if you're only investing in accumulating ETFs which automatically reinvest dividends into more shares of the stocks within the ETF itself, or when you buy or sell stocks and ETFs that are traded directly in euros. But when you receive dividends in another currency like USD, for example, from a distributing ETF or a US stock, these US dollars will automatically be converted to euros by Trade Republic. To do that, Trade Republic uses their interbank rate and adds a small markup of 0.0014 to the US dollar exchange rate, for example, which translates to a 0.14% fee. To put things into perspective, the Giro charges almost double, a 0.25% fee. Meanwhile, on Interactive Broker, you're able to hold cash in different currencies, including USD, which you can then use to directly buy US stocks in their native currency, for example. As a result, there you're not forced to convert dividends back to euros if you don't want to. And when you do want to exchange currencies manually, IB only charges 0.2 basis points. That's 0.002%. However, there is a $2 minimum, so you should only convert amounts over $1,000 or 1,000 euros manually, in my opinion. IB also has a great auto currency conversion service though. For example, if you buy a stock in a different currency than what you have in your account, in that case you only pay a 0.03% fee without the $2 minimum. Okay, what about share lending as an income source? Luckily for us, there's no share lending on Trade Republic, so this is not an income source for the broker. As opposed to the Giro, where you sadly can't opt out of it unless you signed up a few years ago and chose a custody account back then. Meanwhile, there is no share lending by default on Interactive Brokers either. You have to specifically activate it yourself using a margin account, and in that case you get half of the profits from the lending activities, with IB getting the other half. Okay, now let's get to the last income source I want to cover today, card payments. This is only relevant for Trade Republic since they recently launched their debit card, enabling users like myself to directly spend the money that's sitting on our account or to withdraw cash using an ATM. Since Trade Republic is paying 1% Saveback on up to 1,500 euros of payments using the card each month, many are understandably worried how this is sustainable. So here's what I was able to find out. While we don't pay any fees when using the card, Trade Republic earns around 0.3% from each payment from Visa. Now, this still leaves us with a 0.7% difference. Is Trade Republic paying this out of pocket as a marketing expense to attract users? Well, not quite. Let's not forget that in order to get the Saveback in the first place, you need to have one or more monthly saving plans for a total of at least 50 euros per month set up. Only if that condition is met, you get the Saveback added to one of your recurring investments. Otherwise, the Saveback for the previous month will be lost. And as we discussed in a previous section, Trade Republic still makes money from the saving plan itself, even though it is commission-free for investors, as well as from the separate transaction, the Saveback that is invested. Now, you may understand why it is not paid out in cash but needs to be invested instead. That way, the broker can make some of that money back via third-party grants, i.e. payment for order flow and commissions from fund providers. And while it's possible that Trade Republic is still paying a small part of the Saveback itself out of pocket, which is capped at a maximum of 15 euros per month for a reason, there's a good chance they're making it back as new users they were able to attract this way now start using the broker more. Now, you may have heard that the EU recently decided to ban payment for order flow. What does this mean for Trade Republic and their business model from 2026 onwards? That's when they'll need to comply as a German broker. There's no point in speculating too much, but I've heard some opinions that it may be enough for them to simply add a few exchanges to choose from in order to comply with the new law. We'll have to wait and see if that's going to change anything about their fee model, and if they'll still be able to charge a flat €1 per trade. Their co-founder, Christian Hecker, said they intend to keep their saving plans commission-free in the future though, which is great to hear. Either way, as you found out today, payment for order flow is not the only way Trade Republic makes money. And since they now have a banking license which enables them to offer a fully fledged bank account, which they're currently working on, or even issue loans among other things, there's a very good chance they'll be able to find plenty of other ways to generate revenue after the PFOF ban in 2026. But what do you guys think? Do you think banning payment for order flow in the EU was the right move? Or will it potentially end up hurting investors by raising trading fees in the future? Let me know in the comments. Before I take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. You can find my links to both Trade Republic and Interactive Brokers, the two brokers I use the most for my own ETF investments, down below in the description, which is a great way to support me if you'd like to. Thank you guys so much for watching, have a wonderful day, and until next time.